Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Monday, 24th of May. My name is Carl Capilingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we unpack the week that was and have a look to the week ahead. We'll do that after we talk about the ThinkMarkets Difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. Four fantastic reasons to make sure your next ASX share trade is with ThinkMarkets. And if you are new to the ThinkMarkets family and you want to get your account going and get trading before June 30, the first 5 trades are on us. There are some terms and conditions, so head to the website for further details. The agenda for today is to unpack, as I said, the big market moves from the week, including a crypto update. We will look at the top 6 cryptos by market cap, see what's going on the macroeconomic side of things, see where the value is in the Australian market, ask what the charts are saying about Australian stocks, and then have a look to the week ahead. Let's kick off with our crypto update. We've got Bitcoin on screen as we speak now. I do these, it's very early Monday morning over here where I am, and I take these charts for the presentation on Sunday evening. Now, the price of Bitcoin has moved. It's very similar to where it is right now, but we do have a lower shadow coming in to make the candle look pretty much like that. So if you've been listening to the Twitterverse, it is alight at the moment on this prospect of what we call a double bounce in technical analysis terms. So that is 2 tests of a key technical level. And the technical level in this case is, let's call it 30,000, give or take. It's really probably this support level from January this year at 28,781, which we got very close to on that first leg down to 28,869 earlier this month. And just this morning, retesting that, the low was about 31,000, let's call it 200. And a double bottom, retest, whatever you want to call it, the theory here is that you've had the big sell-off, you've removed a huge amount of supply from the market, demand has come in, people that were hoping to buy for a quick bounce have been very disappointed by the fact that it hasn't occurred. They're very speculative, they're in it for a quick buck. They get tipped out of the market, and this is the big 2-letter word, if you can see the demand come in for the second time, it really, solidifies or marks that level out as where the big demand, the big money is coming into the market. We would need to see a candle that closes out today, something that looks like this. If you can see, preferably a white body with a long lower shadow, and that shadow is already starting to develop, but we're still a black body. If you see that white body, long lower shadow, then it would be a pretty strong indication that this very, very strong selling, consistent selling we've seen in Bitcoin over the last few weeks really now has come to an end, and we could well see a rally from here. Whether it's the beginning of the next trend that takes it up to 100,000, I can't say. It's too early for me to be able to say that on the charts, of course. The volume here and the volatility is supportive of what we call a blow-off bottom, where there's been a huge amount of supply that's washed into the market from shorter-term holders, and where potentially longer-term holders are coming in to soak up that supply and lock up the supply. So, as I said, longer-term holders. So once that supply is out of the market, if the demand does come in from some of those more speculative areas of the market, with all that supply locked up, then you can get the rally. So a very, very interesting time in Bitcoin. If you've only just started to join this conversation we have on Monday mornings, hey, you would be not surprised at all by the fact that Bitcoin has tumbled recently, because we have been talking about the move from the demand side market into the equilibrium side market, and then the increased possibility that we will see a sell-off as a result. What we hadn't predicted in these sessions is just how much contagion there would be across the rest of the crypto universe. We had talked for many weeks of the relative strength of Ethereum and the possibility that Ethereum in the medium to longer term takes over Bitcoin as the world's number 1 cryptocurrency. It's still number 2 by market cap, because it has basically moved lockstep downwards with Bitcoin. And similarly this morning, this actually took out that low at 1808, and it is rallying a little bit here. Didn't think I'd be saying this from how strong this was a couple of weeks ago, but Ethereum is kind of relying on Bitcoin's double bottom here to pull itself out of a major dive. So a huge amount of damage has been done on the Ethereum chart Just goes to show Bitcoin's back to number one. Next on the list is Cardano. This is one of the sort of newer generation cryptocurrencies compared to, say, Bitcoin and Ethereum. It does support the decentralized finance, the smart contracts, like Ethereum does. But unlike Ethereum, it's got a very environmentally friendly mining protocol, which doesn't require, the computers on the network to crunch this very hard cryptographical equation to verify the transactions on the network. So it's quite environmentally friendly in comparison, and that's why it tended to better after the Musk tweet that Tesla would not be accepting Bitcoin or no longer accepting Bitcoin for products. But and that's sort of here, but it just could not withstand the broader sell-off in the crypto space. And again, a little bit surprising that it's occurred, but on the positive side, it's holding up a little bit better potentially than some of the others because it's still in this long-term uptrend. The short-term uptrend it's certainly compromised, but if you squint, it's kind of still up, and we will need another strong candle that looks like this today and a follow through potentially tomorrow to tell us that there's some light at the end of the tunnel. But the theme here is a lot of damage done to crypto trends at the moment. As is the case with Dogecoin here, it is settling, I think, below this short-term trend. Long-term trend is still up, but in clear sort of lower peaks, lower troughs pattern here. To be fair, it's actually done far better than I expected. So if you're a Dogecoin holder, there's some encouragement in that, but with the broader damage done here to the trend, I can't see this getting its mojo back anytime soon. And that's kind of the message here, isn't it, on a few of these. Ripple, some major damage done here. This time more about the Chinese government's reiteration of their cryptocurrency controls. They actually added a couple of extra little ones just to boot there, and also reiterating that they are progressing with the launch of the digital yuan, which they hope becomes a bit of a mainstay for transactions for Chinese businesses, essentially allowing them really to track all digital movements of yuan in and out of the country. And the reason why Ripple's done so poorly is it is really an alternative to the yuan, or the yuan is an alternative to Ripple. Ripple is less of a cryptocurrency where you'd be looking to pay for a cup of coffee in Ripple, and more of a payment system that has been designed to replace the current interbank payment system. So Ripple, whilst it initially withstood the Musk comments, has been belted on the Chinese developments and has not bounced, unfortunately. This looks like the worst bounce of the ones we've seen so far. Into the next one, certainly from a technical perspective, looks very similar to Ripple. It held up well on the Musk comments, got belted on the China comments, and hasn't really bounced. So I have some significant concerns for the sustainability of this long-term uptrend in Polkadot. It's not looking good at all at this point in time, and along with Ripple, I would say they are looking the worst too. From a technical perspective, the least likely to experience a quick bounce. Okay, bringing it back to boring old shares, it was actually a pretty good week for the Aussie market last week, edging 0.23% higher. But with most of the sectors gaining ground, you can see discretionary up about 1.3%, financials 0.7%, gold had a great week, up 4% on a 2% rally in the spot gold price. Healthcare up nicely, information technology a big bounce, largely to do with Appen, which had a good week. Property staples up. The losers were utilities. It continues to underperform the broader market. Telecoms down very slightly. Materials had a really tough week on the back of some tumbling metals prices. We'll talk about that in a second. And then energy continues to underperform. Energy prices down a little bit during the week, but our sector seems to have detached from energy prices anyway. Having a look at the ASX 200 chart, we're still seeing a well-developed and well-established and very much intact long-term uptrend, but the short-term trend is definitely under some pressure at this point in time, to the point where we are actually seeing lower peaks and lower troughs here, and interaction with that short-term dynamic trend support zone. The short-term trend for me, I would have to say, is really it's very close to down if it's not neutral, and the long-term trend still up, so that's a tick. And you're going to get these ebbs and flows here within a long-term trend. We've seen it before. It should be no surprise. There's nothing in the chart to suggest that this is a species-ending event for the bull market, and I would expect at some stage we'll get a resumption in that uptrend. But for the time being, it's going to mean a bit of volatility and a bit of frustration for long-side investors. A little bit of volatility and a little bit of frustration on screen now with a whip around the world. Nikkei up, Hang Seng up, Shanghai down slightly, mixed in the US with the Dow Jones and S&P 500 down, but the Nasdaq eking out a small gain, and volatility up another 7%, uncomfortably high, I would suggest. And again, a mixed result in Europe, and those numbers certainly speak to what I talked about before, where we are seeing volatility and we're seeing trends change from what has been a well-established demand-side market into a little bit more of an equilibrium side market where supply and demand are fairly consistent. What we don't know is where we're going to go out of this. Typically, you would bet that we would follow the well-established long-term uptrend, but there is a possibility we do something like Bitcoin where we move into that supply-side market. And we won't know until we get there, and the technical levels are here to guide us. 4056 on the S&P 500. Let me just whip back to the Aussie chart because we want to know the key technical level there. 6861 I think is a key support level. I don't want to see us break below that. I think that would be quite bearish for the trend, and it probably would precipitate a more significant decline into this dark green zone here, and maybe even a test of that 6648. As long as we hold 6861, then there's every chance that we get this up scenario here, this continuation scenario. So watch 6861 on the Aussie market. We talked about 4056 on the S&P 500 index. As long as we stay above that, we're fine. I would say 13,000 is a key level for the Nasdaq. I don't want to see us get below that because we are going to then interact with this zone here. If we got below 12,397, we're probably going to go into a bear market. If we get above 14,212 to the upside, we're definitely reasserting this bull market. But you can see on the Nasdaq, this idea of this equilibrium market is definitely very, very clear here. And that's what we're doing really as technical analysts, as investors. We're looking for when the tide is in our favour, and when we can swim with the tide, things are a lot easier and we can go a lot further. When the tide starts to become quite choppy and uncertain, it gets harder. We're treading water and trying to keep afloat. When the tide turns against us, it's probably time to get out of the water, if you know what I mean. Having a look at the metals here, we've seen some pretty decent declines in aluminium, copper. Not good to see copper going down for the broader metal complex. Nickel, a sharp decline there, 5%. Steel coming off, also hurting prospects of iron ore. And this one's actually down a little bit more than that. Depends on which month you're looking at. So if you're looking at the spot month, the fall was very, very small. If you go out, so spot month is May. If you go out to June, July, August, September, the falls are very similar to this one here. Okay, and actually the contract I'm looking at in China is actually the September contract. Some small gains in the other ones. Gold was up 2%, which helped gold stocks locally. Here's the chart of nickel. We talked about double bottom patterns. This is starting to look like a double top pattern. So the inability to push higher in prices gets people nervous about their holdings. So people that got in here and happy to hold while the trend is up start to go, well, I'm not sure about the trend, and maybe they tip out. Maybe we take this out and we move back into more of a bear market phase on nickel. Having a look at copper, the trends are still amazing, so I'm not too concerned about that. I'd like to see us hold this and head back up again. That would be nice and signal a resumption of that long-term trend. We've seen pullbacks like this before. So nickel, a little bit more concerned. Copper, I think we're still okay. Iron ore prices, so this is the Singapore price, and I've actually gone for I can't remember, sorry, it's either the June or the September contract, but we are demonstrating that we have seen more than that 0.36% fall. It's more like 5 or 6%. I don't like the fact that we've sliced through that support zone. There's plenty of support here at 188. The long-term trend is still up. Let's see how this one plays out. If it keeps going down, then there is still some support here at 174, and we may even see a bounce from there, or we may even see it come back to here. I think we're starting to see from a lot of these charts that this week is actually going to be a really, really key week. in terms of defining the demand-supply environment going forwards. This is the yuan price, so this is the contract in Shanghai. It's not great to see us take out that key level there. It's not great to see us take out this dynamic support zone. We're still in an uptrend, and I guess pretty consistent with my analysis of that US dollar price there, isn't it? We've sliced through some zones, and now we need to see what other levels are going to be tested. Gold, on the other hand, actually looks pretty constructive. We can see higher peaks and higher troughs. That's always a good sign. We can see predominantly white candles. We can see trends turning up here in both the short-term and long-term zones, and they are acting as support levels. The only problem for me with gold is that it is still quite a broader downtrend here. There is some hope that we have broken through that line, but the candles are starting to look a little less enthusiastic towards the upside, so I'm not all that excited about gold. If you're looking for the next great bull market to get into, I'm not sure it's gold just yet. However, if we can see something like that with a great little demand side resumption set of candles that look something like that in that circle, then I'd start to get a little bit more excited. A number of weeks ago, I talked about the gold move. I talked about it down here, by the way, and I gave you a bunch of gold stocks to look at, and they are way ahead. But for now, I'd just be cooling my heels. I wouldn't be rushing into the sector. Okay, let's have a look at energy prices. They were consistently down during the week. The Australian dollar fell as the US dollar index also fell. So we're seeing some Aussie dollar weakness there on the back of those metals and energy prices. And bond yields actually came down a little bit. Aussie 10-year government bond yields on screen. We're still in this zone here. We don't want to see it break below that zone. We don't want to see it break above that area of the zone there. Whilst we're in the middle, we're fine. Maybe the employment data during the week, which was a little bit weaker than expected, has caused bond yields to come down a little bit. That means bond prices are going up, which means flight to safety. US yields held up firmer, you can see straight away, just looking at that comparison on the back of data which continues to show that inflation is persisting and quite substantial. We also saw the release of some FOMC minutes from their last meeting, which actually was before the very, very big miss in their employment data. So it was the data up to that point was looking very, very strong. And there was actually, for the first time, some talk that they need to talk about tapering potentially down the track. So we saw US bonds relatively weaker during the week than the Australian bonds, but we're still in the range, and this is where we want to be. We don't want to be up here, we don't want to be down here. So not so bad for stocks. And if you look at where these peaks have come, if you look at the S&P 500 chart, the S&P 500 chart has done something like that. So we're seeing a movement that's almost lockstep opposite to stocks. So we need to keep an eye on these. They are having an impact. Okay, on to the how we're going this time versus how we went last time chart, which shows the orange line, that's the current recovery from the COVID pandemic, and the red line, which is the recovery from the GFC. And you'll notice just how close together these lines are. They are moving in almost lockstep. There's no reason for that to be the case. Of course, you can say history doesn't repeat, but it does rhyme. The way they're tackling this crisis, that is throwing a lot of money at it, was pretty similar to the way they tackled last crisis, so maybe there is some relationship there. And we did notice 2 weeks ago today that we had reached a pretty important inflection point where the red line takes a very decided turn south. And we questioned what the orange line would do. And we started to make that move. Where we go from here is anybody's guess. But hey, it's a little bit of fun we have on Monday mornings. Not so much fun. Economic data, that's all serious. Some serious data out last week on the Australian economy. Retail sales coming in better than expected, 1.1% versus the 0.5% median forecast, but it was a bit of a slowdown from the previous month. Also, a small pullback in the manufacturing and service sectors, but with readings still well above 50, that indicates we're still seeing growth in those sectors. In China, we are seeing the impact of base effects starting to wash out of some of these numbers. So we saw a 35% year-on-year increase in fixed asset investment, but that's because your comparison from this month, which is the previous month, is way ahead of the 12 months ago down here. And as we start to move further along the curve, we're going to see those base effects diminish. The important thing to take note of here is just where we are with respect to the actual versus the forecast there, and we're in line on fixed asset investment. We were in line also on industrial production. Having a look at retail sales, that was a miss and quite a substantial miss, but unemployment was roughly in line. So retail sales would probably skew that group of data maybe to the weak side. Roughly in line with expectations on some of the housing data in here. I'll let you press pause and dig into that, but not particularly market moving. The Conference Board leading indicators were quite encouraging, a better than expected print at 113.3 and well up from the previous month. But in that data release and the next one also, again, this continued talk of a struggle to access basic raw materials for production, spikes in energy prices. And unfortunately, when you put all those together, it does point to inflation ahead, and many of the businesses in some of these surveys, the talk is of them questioning whether they can start to pass some of those high prices, input prices, onto consumers. And the feeling is generally that with the economy recovering and demand juiced by stimulus checks, that they can. So it does indicate there will be some consumer side inflation down the track, and that we know the Fed is going to keep a very close eye on that. But for the most part, the data very, very strong. Services way ahead of expectations there, and manufacturing also beating. Also beating was the weekly jobless claims at 444 versus the 453 expected, and we are seeing a very nice trend down here, but we're still well above the 200 to 250 odd thousand which we were getting before the start of the pandemic. Having a look at where the value is in the Australian market, or if there is value, and we are starting to look a little bit better here on the PE side of things, or certainly the relative PE versus us and the developed markets. And I think this is the first time since I've started doing these Monday morning updates that I've seen our PE below 18. So this is our 1 year forward PE, and it compares quite favourably to the developed markets PE of 19.3. If you're looking for the cheaper sectors, well, materials is still the cheapest. That's at about 12.3, but a little higher than a month ago. Energy is the next cheapest at 15. Charts there don't look as constructive, unfortunately. Financial sector, very, very strong sector, and the third cheapest in terms of PEs. The IT sector is still by far and away the most expensive. Having a look at some of the technical factors for the Australian market, we can see a bit of a change here. So last week this was up, and because of that move into the price action downtrend, lower peaks and lower troughs, which looks like that. In the short term on the Australian market, we are now in a neutral trend. It's a little bit concerning because when you think about what that picture means, you think about the supply it takes to push prices down, and the supply is building, isn't it? To make those peaks lower, supply has to be building, and demand is struggling to keep up with that supply. So that is the reason for us moving to a neutral stance, I should say, for the short-term trend, but the long-term trend is still intact. Discretionary actually switched up from neutral to up, so that's looking encouraging. Energy still very bearish at the moment. Financials, the opposite, very bullish. Healthcare actually starting to look very interesting. That's also gone from neutral to up. CSL looks interesting there. EBOS looks very interesting there as well. Ticker code on that one is EBO. Information technology has had a bounce, but it really only has got itself back up to some key resistance levels, so I'm still concerned about that sector. Material sector has been disappointing. It's been one of the ones I've liked for quite a while now, and that has been downgraded from a clear short-term uptrend to now a short-term downtrend, unfortunately, but the obviously the long-term trend is still up. Properties looking half interesting here, as is staples. Telecoms a bit mixed, and utilities are clear-cut down. We have also seen an improvement in the market breadth. So this is the number of stocks participating in the rally at the moment, and this is showing you the percentage of stocks that are above their 5-period or 1-week moving averages to spike back up to 60% despite the short-term downtrend. That's encouraging, and we've seen that substantial improvement continued out to about 1-month trends, and then smaller improvements out to 5 months. But we're, as you would expect, for longer-term trends, they are less impacted by short-term price movements. Nonetheless, it's encouraging to see these developments, but we are a long way off this green line, which is kind of the ideal case scenario where we're, about 2/3 of the stocks participating in the rally. We'll keep an eye on that one. Also keeping an eye on the data out this week. Well, not so much in Australia. There isn't anything on screen there that will actually move markets heading into overseas markets, primarily China and the US. We do have some data out this week which may move markets, the preliminary reading of GDP, but more important, I would suggest, is going to be durable goods orders, and then the biggest release for the week will come out Friday night our time, and that will be in the form of the core PCE index. PCE stands for personal consumption expenditures, and this is the Fed's preferred measure of inflation. This is the one they look at the most, certainly more so than the CPI and PPI data. We are forecasting an increase of 0.6% for the month. Chicago PMI and University of Michigan Consumer Sentiment surveys to end out the week. Well, that's it for me this morning. Thanks for listening. You can get all of our other updates in the market news section of the website. If you like, you can follow me or the Think Market handles on Twitter. Tomorrow, we will have the Ask the Experts webinar where you get to bring your portfolio to the table. So register for the webinar in the webinar section, join us, and throw me some stocks that you're interested in right now, and I'll give you a quick fundamental and technical on those. Also register for some of the other webinars we've got upcoming. The disclaimer before I leave you today says that everything we've discussed this morning is general in nature. We are also a regulated Australian broker, and you should consider that we do have some products that could see you lose more than your deposit. So please read this disclaimer carefully, or if you have any questions at all, give us a call. Thanks for joining me this morning. All the best for your trading. Until we catch up again, bye-bye for now.